Now, we have done something a little bit different today. We have two stocks of the day because we could not decide which way to go. So the first of the two stocks is Origin Energy, and we have an update on the takeover saga. Its shares are down after it rejected the Plan B proposal lobbed by its bidders, the Brookfield-led consortium, as a last-ditch attempt to buy the company. And Origin's board said that the revised proposal was incomplete and highly conditional. Okay, let's have a check-in. So Daniel, Origin Energy, it has been a saga, and it'll be interesting to see how this reflects on Australia as a potential for takeovers.
Absolutely. I think probably from, at least a shareholder registry perspective, when you have a large activist investor, and to AusSuper, the amount they've invested in Origin, it's not really even material to their assets under management. So, that they clearly have a lot of power there. I think overall, like you said, Danielle, it actually does have a bit of a reflection on the investment base in Australia, though historically takeovers from international players have happened pretty seamlessly on the market. So I think it's probably been one of the most interesting transactions to follow. Certainly it's been a long time in the making. I'm sure the advisors are happy about that. Look, our view of the company, we've actually sat on the sidelines for most of this time. And I think we had a great overview on it on the call, the last episode I was on with Gaurav, but there's certainly an interesting valuation play in Origin emerging. I think there's genuinely good reasons to separate the energy markets and the APLNG assets. And obviously the jack in the box, which no one really knows much about, is Octopus Energy. So from a sum of the parts perspective, I think it's actually quite interesting. Post all the ongoings with the deal in regards to what price the stock will trade at, what valuation it will be, etc. I'm sure there's a lot of non-long-term investors sitting in this one, perhaps for arbitrage, which will be coming out. So I'll be watching it quite closely. If you're in the stock, at this point you're probably still happy to hold. But I think there's a really great opportunity for people to watch this one and see what happens if the takeover doesn't go through.
Yeah, so basically you're talking about potential sum of the parts here being in excess of what the valuation may move to. So a buy on weakness? Or just watch it
my
at this
view's always
stage?
been waiting the sideline, because I know it's a very different type of acquisition, but if we look what happened with Liontown when that deal failed, it's more than halved.
Yeah.
Now that's a very different circumstance, but I would suspect that a lot of people are going to be exiting Origin if the deal is finally done and dusted and it doesn't go through. So I would be waiting on the sidelines. Buy on weakness, probably if you have a great understanding of the clarity and the strategy going forward, because it's going to be costly to separate that business. It's not as straightforward as you think. Tax implications and all the rest of it, debt implications. So I'd be waiting on the sideline, but keep a firm eye on it.
Okay, Michael, what do you think?
Yeah, pretty much similar thoughts. I mean, generally with these takeover offers, I'd prefer just to sell the stock, because when you think about the risk reward, maybe you can get a little bit of a higher price, but the risk is that if it doesn't go through, the shares fall back to where they started. With Daniel mentioned Liontown and Ramsay Healthcare. There's been so many out there where you're just better off taking it off the table. This one's a bit unique in that it's been dragging on for a year, and it's basically reached a point where it's trading pretty much what it's worth. So even if it was pulled, it's highly unlikely it will drop that much. If anything, it might even get a bit of an uplift because of, as Daniel mentioned, you can break up the business. So, look, it's not one I'm generally not interested in a business like Origin, so I haven't been following and I don't have clients in it. But I think if you were sort of interested in seeing it through, I think at this point it would be a hold. I wouldn't be buying it either. I just don't understand it to the finite detail. And I think generally when you've got a share market that's down at these levels, and there'll be other opportunities to make money, I guess, in a, dare I say, an easier way than sticking it out with Origin. But look, if you've got it, you understand it, stick with it, because it's not. I don't think there's much downside risk from here.
Fair enough. And let's move to the second stock of the day, which is Iress, and they have upgraded guidance and posted its strategy update today. So transformation accelerated, delivering early benefits. And basically there's been an upgrade in terms of the revenue growth, and the cost base is more favourable, and they've had an uplift in consumer sentiment. They're citing innovation is underway and the UK strategy is further evolved, as well as non-core UK assets are being sold to retire debt. So as I mentioned, that guidance has been upgraded at the EBITDA level for full year 23 to between $123 and $128 million versus previous expectations of $118 million to $122 million. Now, Daniel, this really has been quite a disappointing stocks for lots of investors. Do you think they're making some right moves strategically at the moment?
Yeah, I think the investment case for Iress in recent years has always been about the core business in Australia, and I'm not sure if you'd say the product is really good. We use the product for our managed funds, and it gives us a few headaches at the times, but it's something that does have a really strong market position and definitely pricing power. But there's been so many headaches in the international assets, write-downs, impairments, and they've used debt to acquire those assets, which is always troublesome. So from our point of view, based on the update today, it's the right steps, but there still is a significant amount of net debt in the business. And no matter what, they're talking about moderating cost pressures now, but we know that whether it's the employee base or it's other IT costs, there still is significant inflationary pressures just industry-wide. So I'm probably a little bit more sceptical in the medium to longer term of that. I think there still will be pressures in that cost base, but certainly making the right moves. And we joke about these companies all the time in our team. We say these bombed out stories, someone's got to make a lot of money, but we just don't know if it's on the long or the short side. So I think we're happy just to be on the sidelines again. If I was in the stock now, I don't think you'd be selling into strength, for example. I think you'd be happy with today's update, but for a buy, I've got to see more from the company at this point.
Fair enough. And Michael, what do you think of Iress?
Yes, similar thoughts again. It's up until today. I mean, it has been in a downgrade cycle. It's lost half of its share price over the past couple of years. I think I was last on the show a couple of weeks ago, and we looked at Iress, and my thoughts then were, it looks like it can go up a little bit in the short term, and that'd be a chance to sell. Do I still think that based on today's announcement? Well, I mean, it's nice that they've upgraded guidance. I mean, that's a welcome change. I'd probably hold on to it a bit longer. I'd still be looking to sell it a bit higher up if I can get a higher price for the same reasons. I mean, you speak to anyone that uses Iress and they do so begrudgingly.
It's not a good sign, is it?
Well, I mean,
there is no alternative, so.
Yeah, look, that's the reality, and they've done well because they've taken costs out. Well, maybe this is the company that needs to be investing in the product. So if they're stripping out costs, I mean, what are we left with from here in terms of the product? So it makes me wary that they're going to gain a lot of market share from here. Look, I think it's still a bit too hard to call this the big turnaround.
Yeah.
So a bit more upside in the short term. I'd be happy to jump out and move on to something else.
Fair enough.